When I started my investing journey, I was scared of the many charts and numbers my mentor taught me. Initially, it was confusing to me, but then that's just partly what investing is all about. If, like me, you don't start with the correct foundation, you would get confused and think it's more complicated than it is. I'll help you to get a basic understanding of what investing is all about. For example, let's say you have the gift of building businesses. You started a brewery and made it successful, but now you want to expand the business, or maybe you just want to tell the world how successful you are. So you want a private jet, but as a savvy businessman, you don't want the funds to come from your finances. So what would a business person in this situation do? First, they break the company into parts called shares. Then they'd sell some of these shares to the public. At the same time, they would keep the central part of the shares for themselves. They don't want a stranger to control the business. And what market makes this possible? It's the stock market. The process for doing this is called an initial public offer, or IPO. An IPO is when a private company, like your brewery, wants to go public. The company works with investment banks to make this possible. Most companies sell only a fraction of their shares to the public and keep a more significant part. Other people would buy the shares or invest in the company if they believe it is profitable. I would encourage you to watch this video to the end. You will learn how Warren Buffett makes extra money in the stock market there. Do not skip any part because we are going on a journey of opportunities in the stock market. Also, please give it a thumbs up. Don't forget to subscribe and turn on notifications. A company can raise a lot of money through an IPO. Let's consider Mark Zuckerberg, the founder of Facebook. Facebook was his little toy that he made successful. But then, in 2012, he decided to open the company to the public. He asked people to buy 337 million company shares at $38 per share. The IPO was a success. Then he got another idea. He realized that the demand for Facebook shares was high, so he decided to raise another 84 million shares to the public. Within hours, investors bought every one of those shares for a total of $16 billion. Mark Zuckerberg became a member of the Billionaires Club. Guess what happened next? The stock price rose that first day of trading to $4 to $5. His net worth rose instantly, but then it crashed back to $38 per share at the end of the day. To cut a long story short, the stock price crashed again within a few weeks to $20 a share. It was a more than 40% crash, but the lesson was that Mark Zuckerberg was already a billionaire, and people looking for instant riches were disappointed at that time. That's literally how the stock market operates. Some make their riches in hours, and some disappoint within a short time. When the stock market started, people bought shares for dividends. That means that when you buy a stock, you become an owner of the company. Every company owner has a right to share in the company's profits. But in real life, that's a theoretical statement. When you buy a stock, do you buy for dividends? I would like to know your views. Post it in the comments section. Also, tell me where you're coming from, so I can make videos for your location. I like to hear from people all over the world. Now let's get back to the video. Let's take Facebook stocks, for example. If someone had bought 10 Facebook stocks in 2017, he would consider himself one of the owners. But does that mean he has the same rank as Mark Zuckerberg? Well, I'm just kidding. It's not literally. That year, Facebook made $16 billion in profits. So, how much of that profit will come to your pocket? 10 stocks at that time would be bought for $1,300. Does that mean your $1,300 is now worth billions? Not so. This is because you are not the only one who bought Facebook stocks. That year, there was almost 3 billion Facebook stocks in the hands of shareholders. Shareholders are people who own stocks in a company. How much can your 10 stocks compare to 3 billion? If the profits are divided by the number of shares, your 10 stocks will give you just $54. Yeah, just $54. That's what is called your earnings per share, or EPS, so your EPS would be $5.40. It's laughable, not so? Well, theoretically, that's what Facebook owes you that year. But actually, they didn't pay anything. The decision to pay shareholders lies in the board of directors' power. They might decide to use the profits to fill their pockets, or they might use it to expand the company. So, your 10 stocks don't matter in the sea of stocks. You wouldn't think you were scammed. That's just how the market works, but some companies behave differently. Take Apple, for example. In 2021, Apple paid earnings per share of $2.50. In total, what it means is that they paid $13 billion in dividends to all their shareholders. $2.50 might not be much, whereas the stock has a price of $170. But you might be thinking, it's better than Facebook, which paid nothing. You're right. But sometimes dividends don't matter. There are some stocks called growth stocks in the stock market. Apple is among the growth stocks. The capital gains on growth stocks make them attractive. In 2021, Apple's stock gained 33% in a single year. It was among the highest growth stocks that year, and higher than the market average. In 2021, Apple became the first company valued at more than $1 trillion, but then its stock price was about $200. In June 2014, the stock price was $645. So why was its valuation not more than $3 trillion? It confused me initially, but I will break it down for you. The secret behind that story has to do with stock splits. A stock split is a simple process. First, the board of the company increases the shares of the company. So, for example, they could say, let's do a 3-for-1 stock split. That means if there were 1 million shares, the shares would increase to 3 million after the stock split. Do you like stock splits or not? Hit the like button to tell me how you feel. Also, don't forget to subscribe to this channel. I release new videos daily, so by subscribing, you won't miss any of the videos. Now, let's get back to the video. The secret of stock splits is that it doesn't change the company's valuation. Instead, what happens is that a stock split reduces the price of the stock. Due to the reduced price, the company's valuation remains at the former level before the stock split. That was what happened to Apple. Apple did a 7-for-1 stock split. That means each stock in Apple was divided into 7 parts. The price nosedived after the stock split, and the valuation decreased by 7. So, after the stock split, although Apple's stock was worth $645, its valuation did not change. That's just the simple math. Many companies do stock splits when the stock price is very high. This is because a high stock price would make the average investors unable to buy the stock. That's what companies don't like. Apple wanted people to find the stock affordable. They wanted more people in the Apple investors community. Now you see why some successful companies like Apple, Microsoft, and Google are still affordable, although they are growth stocks. But not every successful company does stock splits. Some companies do not mind if the price of their stock is out of the average person's reach. These companies only want a few serious people to own their stocks. That's the case with Warren Buffett. Warren Buffett's company, Berkshire Hathaway, has never done a stock split throughout its existence. As a result, the number of shares it has is very small. There are just 1.7 million shares in Berkshire Hathaway. Compare that to Apple, which has 5 billion shares. According to demand and supply, if the demand outstrips supply, the price of an asset will rise. That's what happened to Berkshire Hathaway's stock price. Its stock price is currently $412,170. It's far out of the reach of the average investor. Warren Buffett's company is only available to a select few investors with that kind of money to spare. Well, there's also another strategy. Buffett knows his company is booming, and people want his shares. So what he did was to create Class B shares in his company. The Class B shares are worth $280 per share. This one is quite affordable for the average investor. It is also a way for Warren Buffett to earn extra money for himself. You see, the stock market is a vast topic. We could discuss without end the various opportunities for investors in the stock market. But this video has to end. Now, if you want to watch more videos like this, then you need to watch this video right here. This video is one of the best on this channel. You can click on this video to watch further.